Once again, thank you for listening. I truly am honored to be a resource. Recently, someone asked me to explain if there are any additional benefits with having capital inside of an insurance contract. And looking at that last example in my previous video to you of that client doing 120 grand, they said, Kelly, seriously, other than building tax exempt, there's got to be other benefits associated with it. So I thought I'd explain that to you as well. And I even have the notes from the previous video, so I'm just going to add to them. So let's go ahead and switch over and do that now. Okay, so here we are again. Hopefully you remember this client of mine. Now, if this guy could buy the $2,800,836 worth of life insurance as a term policy and only pay $2,946.12 per year, why in the world would he direct $120,000 per year for the same death benefit? You already know that he'd be creating a ton of capital inside of an account that could be distributed tax exempt, but there has to be other benefits, and there most definitely are. So let's explore those. I'm going to go through these pretty quick. Number one, you get a tax-free accumulation. So on the way up the mountain, you don't have to pay the taxes on the growth. Number two, on the way down the mountain, you have a tax-free distribution while you're alive. You don't have to actually die to get the money. Number three, you have a tax-free transfer to your spouse. And number four, you have no penalty to access your contributions prior to age 59 and a half. Now, do these first four sound pretty familiar to you? I mean, have you seen these before? If so, you would know that these are a Roth. Now, a Roth has a couple more. I'll get to those in a minute, but these are the four primary benefits of a Roth IRA. Now, number five, what are there additional benefits that aren't in a Roth? Now, you might have heard that insurance is referred to as the super Roth or the Roth for the wealthy. Well, let's take a look at why that is. Well, one beautiful part, so the fifth benefit here is you don't have a penalty, not only to access your contributions prior to 59 and a half, but you don't have a penalty in your insurance contract to access your gains prior to 59 and a half. A Roth doesn't have that. Number six, you have a tax-free death benefit. Roths don't have those either. Number seven, there is no 1099, meaning there's no communication between the IRS and the insurance company whether money is going in or out of the account. So a proper distribution doesn't hit your 1040, which means it's not only tax-free, but it's also tax exempt. Number eight, because it's tax exempt, there is no means testing on your Social Security or other government cheese. We like that one a lot, which I demonstrated that to you in that longer video. Now, I will say this, that a Roth also, even though a 1099 is generated with a Roth, I discussed that before, but a Roth also is not means tested. So a Roth does have this benefit. Now, number nine, money inside of an insurance contract is not subject to creditors. Now, this is state by state, but over 30 states in the union have 100% protection of all capital inside insurance contracts. And now, it's a bad example, but it's a good one. You got to think O.J. Simpson. He was found liable to the Nicole Brown family, but he didn't pay them a penny because he had his money in insurance contracts with the state of residency in Florida, which has 100% protection. Another reason why a lot of people retire in Florida. But think about that. Think about storing capital in a position to where creditors can't touch. That's a big one. Number 10, this money is not subject to the AMT tax, the alternative minimum tax. Now, I think this is one of the most egregious taxes out there. It's painful, but money inside of the insurance contract is not subject to that. It looks like potentially, with some Trump tax law, this might be gone anyway, but inside of these contracts, there is no AMT. Number 11, you definitely have a competitive rate of return. When you net everything out, when other investment accounts have fees and potentially have taxes along the way or riding the roller coaster going up and down and you net that out, insurance without a doubt maintains a very competitive net rate of return. Now, number 12, there's also a provision called waiver of premium. Now, this is amazing because if you become disabled and you cannot make your contribution, so if this guy up here became disabled and could not make his $120,000 a year contribution, the insurance company will do so. And insurance companies cover up to 20 grand a month, meaning 240,000 of annual premium. So imagine if this policy for this guy is designed this way to be about cash, not life insurance, and the insurance company, if he becomes disabled, will continue to accumulate inside his policy for him. They will continue to fund it. So it's a self-fulfilling, even in the condition of disability, which is fantastic. Number 13, there's chronic and terminal illness riders. Meaning if you are chronically ill and are terminally ill as well, and the insurance company knows this, they'll allow you to have access to a large portion of your death benefit, whether that can be used for anything to help pay for your final care, to help have a surgery if you want. They know they're going to pay the death claim, so they'll give you a portion of it. That's fantastic. Number 14, there is no market risk. Right? There is no such thing as riding the roller coaster up and down. That's critical mathematically. Number 15, and this one is very important, specifically as you're building capital, and then when it's time to even use it later on, there are guaranteed loan provisions, meaning no matter what, you always have access to your capital. There's no qualification. You have access. This guy has access to utilize these funds at any point in time. Number 16, you have the ability to make unlimited contributions. Now you would think that that would counter what we talked about here being the government max. But let's just say, for example, this guy couldn't do any more than 120 grand a year into his insurance. Let's just, for some reason, let's say he couldn't get more insurance. But he wanted to do $80,000 more. He had an additional 80 grand of capital to direct. Well, what we could do is just direct that to his wife. Right? If he was insurable for more, we would just say, well, okay, you want to do 200 grand? Well, how much does 200 grand buy? Maybe that only buys $3.5 million, right? Can he qualify for that? See, makes sense? If he maxes out himself and his wife, he could also do this on his children. He could also do this on business partners, all right? So you really have an unlimited contribution capability. And lastly, number 17, money inside of your overfunded insurance contracts can be used as collateral. And this one is absolutely critical. This is key. It's the critical component to how you use these monies later. It's a concept I call collateral capacity. And it's why banks hold billions and billions of dollars in these contracts. Let me show you what I mean. Delete this. This is the financial zero line, right? You must remember that we finance every single thing we buy. You either pay interest or you lose it. So this is the one who pays it, who I call the debtor. He wants something bad enough that he'll go into debt for it and then make payments to get back to the zero line again. And it starts all over. He does it again, he buys another car, he does it again, buys something else, he does it again. Now the saver, what this person does is they delay gratification, right? She saves up, then pays cash, then saves up again because she wants a new car, then she saves up again because she wants something else, then she saves up again, but both of them get back to zero. And this works actually mathematically as well. When the variables are the same, if this person could have earned 5% and this person is paying 5%, they get to the exact same spot. They both lose the opportunity to earn interest on their money. So the debtor paid interest and the saver lost interest because she continued to deplete her account. Again, mathematically, these are identical. Now, within this model is the third type, one who has collateral capacity, what I call the wealth creator. Here's why. Their money never stops compounding, even if they use it. You see, if this individual wants to buy what these two bought, then they simply put a loan against their asset and use it as collateral and then pay the loan off, just like the debtor and just like the saver replenishing their account. It's the same thing, only the wealth creator never lost the ability to earn interest on their money, right? This is exactly what banks do. If you and I were partners in a huge construction project, let's say we were building a $100 million golf course in Florida and we went to the bank, would they loan us the money from the depositors, right, from what they have on hand? I mean, no way. What they do is they leverage their billions of dollars in their insurance contracts. Bank of America has like 24 billion. Chase like 20 billion. They have so much money in life insurance reserves, it's crazy. So what they do is they borrow $100 million from the insurance company. There'd be a loan against that, and you and I would pay that loan back. All the while, their money never lost the ability to earn. They just simply used it as collateral. Now, real estate is no different, right? If your home is free and clear and you have no mortgage and you decided to put a mortgage against it, would the value of the house change? I mean, of course not. The loan against the house has no bearing on the value of the house itself. This is the part I love about what I do, by the way. Again, I believe you deserve the opportunity to get what you want and have your assets positioned in such a way that when it's time to finally use those assets, you are completely exempt from both federal and state income taxes, regardless of the income level and regardless of the state that you reside in. So here's how we do it. You climbed the mountain, right? You did it properly. You ensured you had some proper financial tools and were effectively balanced. If you get back to the balance, the little teeter-totter, you were effectively balanced when it was time to distribute your wealth. So in this case, you had a large amount of capital in your overfunded insurance bucket. Now, let's take a look at that. Just like this guy doing $120,000 into his insurance. The year that you decide to use it for income, you put a loan against it. And again, loans are guaranteed with the insurance company. Loans are not a taxable event. They do not hit your 1040. Could you imagine if loans became taxable income? Holy crap, that would be a huge disaster. Loans are not taxable. This is a loan from the insurance company, which you are guaranteed to have access to within your policy contract. And it's a loan using your entire cash value as the collateral. Because it's a loan and not a withdrawal of an asset, it is completely tax-free and doesn't have a place to go on your tax return, which means you have zero means testing for your Social Security and any other benefits, regardless of the size of the loan. Does that make sense? Now do you see why this client of mine wants to put 120 grand a year into this thing? Along the way, he can use it like the bank did. He can borrow against it for opportunities without any headaches. But when it's time to use it as income, he takes loans against it to create the spendable income. And he doesn't have to pay it back because his asset's the collateral. So his first year, the loan is small compared to the entire value of the bucket. Now it does have a small interest expense, but our entire bucket is still earning, so this loan would never catch up to the entire earnings of this policy. The next year, he does the same thing. And so on, and so on. All the while, the entire balance is still earning. He's simply collateralized his retirement spend down. This is why people shove money into these things. This is why you'll often read how the wealthy use insurance, but it has nothing to do with the wealthy. Anyone can do it as long as they qualify for the insurance. Now, if you're not structured in this way, then I'd be curious to ask you why. I'm sure in the very first video when I asked you how much of your financial pie you wanted to share with the IRS that you said, I don't want to share any of it. Well, so if that's what you want and you have the opportunity to make it happen, then why don't you have what you want? Proper expertise is important, that's for sure. My calendar is available to you by simply clicking the button below. You can book a time with me directly. Let's take a look and discover what opportunities exist for you. Again, I believe you deserve the opportunity to get what you want. Hopefully I can chat with you.